Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the micro bullish scenario where we're looking for a zigzag 535 corrective structure ABC for then a move back towards the upside to at least take the highs over here at 28.6k. The most common target for wave C is between the 1 and the 1.236, taken from the high to the low of A to the high of B, which as you can see has been nicely respected. And a less common target, but a target nonetheless, is the 1.618, sitting at 25.9k. Support area in between here is between 26.2, 26.3, and also right below the 1.618, 25.7 to 25.9. Now, if this is the low of C, you want to see bullish structures to the upside, and that starts to be a little bit of a problem over here, which I will explain when going over the local counts, which is this range over here. However, at the same time, if we do expect another low based on probabilities, then we also get into problems with this wave C, because this range over here is much longer than any previous range we had before. And if we look at a potential 1, 2, 3, 4, 5 to end wave C over here, with also then a wave 5 on lower volume than the highest volume in wave 3, this range is about 6, 7, or 8 times longer compared to wave 2. Now, yes, wave 4 tends to be longer than wave 2. However, then we're thinking about like 2 to 3, maybe 4 times longer. But going to 6, 7, 8 times longer for wave 4, this starts to be a different degree. Like it lowers the probabilities that if we move down, that it's still part of a wave C. And it increases the probabilities that we might be in a more bearish structure where we're looking for a 1, 2, 3, 4, and eventually a wave 5. So now this wave 4 and therefore this sideways range is compared to the much bigger wave 2 over here. In this particular scenario, we are then looking over here for the end of 3, then we have a sideways wave 4 and then a wave 5 to the downside, where an invalidation, but I just call it a key level because you have 2 lows over here that you could use, could be 27.160. because you don't want to see overlap between a wave 1 and a wave 4 in a normal impulsive structure to the downside. Preferably these do not cross, and therefore if this is the low of your wave 1, you don't really want to see price now moving to 27.160 and this over here to be the high in a more complex sideways WXY structure. Now the 0.236 is a target for a wave 4, so that is nice, and at the moment is quite well respected as well. If we look at the highs, the only high that went above was the news high over here, but since then it's been ranging again, and then we do expect another move towards the downside. Now if we then zoom in and we look at the bearish scenario first, where we do expect another low to be made, then over here what you see is a WXY complex corrective structure. So we then have over here an ABC in wave W, an X, and then eventually looking for a wave Y. Now because in a sideways double combo, wave W and wave Y are not allowed to be the same structure. If W is a zigzag, Y cannot be a zigzag, so it leaves a triangle or a flat. And in this scenario, I think a flat might actually be interesting for 2 reasons. First, in a flat, if we look for an A, B, and then a wave C, the most common target area for a wave B is the 1.236 to the 1.38, which is in confluence with the point of control of the range and the value area low. So price could move down, hit this area, and then see a wave C to the upside. Secondly, the confluences. We also have a daily over here in this area as well, but then a minimum target for wave Y is the 0.618 taken from the low to the high of W to the low of X. And you can see that the 0.618 is in confluence with the naked point of control of this little range, or actually the news event really. So the point of control is at this level, 27.034 on my Coinbase chart, in confluence with the 0.618. So first moving to the downside, hitting the point of control, then move towards the upside, hit the 0.618, hit the point of control over here, and then continue down is definitely an interesting area. In the bullish scenario over here, we are looking for price to make a low. This is the low over here, and we would then want to see bullish structures to the upside. Now in this scenario, because of all the overlap, there's two things to think about. Either we have an expanding diagonal coming up here, but that is very rare in general, or we have a double 1 2 where this is then wave 1 2 1 2 and then continuation up. Has to be said that if this is the second wave 1, meaning a wave 1 of a lower degree, this one is longer in price than this wave 1 over here, so that is not ideal. But also, if this is 1 2 1 2, you look for 3, then this wave 2 preferably is not longer in time than the first wave 2, because then this wave 1 is longer in price, this one is longer in wave 2, but this second wave 1 and the second wave 2 should be a lower degree wave 1 and 2, so preferably shorter in price and shorter in time. Now this wave 2 then should not cross the 1-to-1 fib time taken from the high to the low over here, and then put on this high to compare the length of the blue 2 with the potential 2 we have here. The 1-to-1 is sitting on today, Sunday the 15th of October at 1:45 p.m. Central European time. So there's not much time left for a wave 3 to start towards the upside, right? So yeah, this is something we at least have to keep in mind. So if we keep ranging, or even if we move towards the downside and we reach this wide level over here, bullish scenarios are even going to get lower and lower and lower probabilities. Now if we then look at the CVD divergences, then we have over here bearish CVD divergences still active, more locally bearish CVD, which haven't yet played out. Bearish CVD here, bearish CVD here. So yeah, quite a buildup of bearish CVD divergences. We also over here have bullish CVD divergences, have not yet played out, and while moving to the upside got countered at the moment a little bit by the bearish CVD divergences. Has to be said that the CVD between these two highs, lower high on price, higher high on the CVD, have played out as these lows got taken, which is the minimum target for a CVD divergence. So we could now remove this one from the chart, leaving us with the second CVD divergence here. So with this high, these highs now create a CVD divergence for the second time with this pivot, and that means it lowers the probabilities of it playing out. So we had a bearish CVD here, played out, price moving to the upside, bullish CVD in the picture. Now you see a second bearish CVD with this particular pivot, lowering the probabilities. But hey, we'll see how this works, of course. So if we then go to the probabilities of the different scenarios, then at the moment, on the micro as well as more locally, probabilities start to increase for price to make another low. Based on what we see over here, the bullish scenarios don't look that great and the bearish ones do look a little bit better. And we also have to start thinking about potentially an impulsive structure to the downside if price will find another low. Now, I hope that this video was helpful or valuable to you. Please make sure to check out the most recent educational video that I have made about, in my opinion, the best trading indicator you can use, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye-bye.